All right, today we have a stock analysis of Supermicro Computer Incorporated, ticker symbol SMCI. Personally, I have been critical of this company in the past as a CPA and former auditor, a financial statement auditor, when they were delisted in 2018 because of late regulatory filings. And then again, I think last year, they were threatened to be delisted because of their missing those regulatory deadlines. This is a company that I see as somebody who struggles with some of their accounting practices, some maybe dishonest. When that happens, that lets me know management isn't doing what they're supposed to do concerning the administrative part of the business to make sure that the records are ready and available and accurate. So that lets me know that this is not a management team for my investment. However, this company is very popular. Of course, it's a server business. And as we know, with the cyclical nature of these computer businesses that are in AI, whether it's computer chips or servers, with AI being in a boom right now, this company is getting a lot of attention. And they do have some earnings, so I think it's fair to evaluate them. For those that are high on this business, it's fair to give evaluation and see where they stand. So a few things I want you to keep in mind. One thing, of course, I like to invest in businesses that have value, that are trading at or below fair value. I love it. What I've learned to love more is the quality of the business. What's more important is the quality. Is this a quality business? Throughout this analysis, I'll point out some things that communicate to me that whether this is a quality business or not, and hopefully that can help you determine what you deem to be a quality business. So let's get right into the analysis. First, looking at the chart. One thing I want you to understand, this company is trading at $30.46. The market has not always been high on this company. As you see, we only have about, looks like less than a year period here in 2024 to 2025, where this business was trading at a high valuation, over $100 here. Ever since then, this company has come down and been pretty flat over the past couple of years. So we only have a short period of time where the market was really excited about this business. And I think that's for various reasons, but we'll get into it now. Another thing to note why this company has dropped recently and why they've been hitting headlines is the company announced a $7 billion raise of money. So they want $7 billion more money to fill some orders that they have. And investors are kind of running away because of how they're going to raise this money. They said they're going to do it through equity raise, meaning they're going to sell shares, and equity linked methods. So pretty much bonds that are tradable, that can be traded to equity, or debt that can be traded to equity later on. And investors don't want to be diluted more than what they've been diluted already. So as we know, when you create more shares or authorize more shares and sell those to the public, more owners of the same business means the existing owners own less of the business. So this is what has investors thinking it's maybe time to sell this company here. So as we see, again, short period of time with this company was pretty much what had the market excited. Ever since then, they've been pretty much flat around $30 to $50 per share. Let's get into more of this analysis and see where we land on the valuation. Now, looking at the revenues of this business, 2016, 2.2 billion, 2025, 21.9. So excellent growth. Just looking at the surface, trailing 12 months, 33.7. So they're trending to go even higher this year, which is a good sign. A 5-year average, 49% growth year over year. This is amazing. Now let's look at the margins. Looking at gross margin, we're looking at how much money is left over after you cover the cost of delivering the product. 331 million in 2016, 2.4 in 2025, margin of 11%. Now, if you notice, this margin is not as high as other margins. Why is that? Why is this company growing and they're hitting some record years, but they go from 14 to 15 to 18, now they're back down to 11? When it comes to these AI servers, these servers for these supercomputer chips, what happens is it costs more to do so. So their margins are going to be constrained. Revenue is going up, but margins are not going to be as strong as they are incurring more costs to produce the servers for these high performance chips. And we're seeing that right there. We see that dip down to 11%. Looking at the net income ratio, 3.2 in 2016, 4.8 ratio here. So same thing goes all the way up to 9, 7, and back down to 4 and 3.7%. So we see we're trending to make more money this year over the past 12 months. However, our ratios or our margins are constrained because of those higher performing chips. So here's another image of that, of what that looks like. I'm about to say, where'd the graph go? Here we go. Now we see the trend line of revenues pretty solid going up, right? But gross margins are barely trending up. They're pretty much flat. So this is not something that we want to see. When I talk about quality, this is one thing I would like to see. I want to see margins trending at least at the same rate as revenue or higher than revenues. I want to see a company become more efficient as they get larger, and we're not seeing that. Revenues are going up, but this company is getting less efficient. So this is one sign that this is not a quality business to invest in. Another sign of quality, this is in a company that's in the computer hardware industry. As we see, gross profit margins over the past 5 years, 14.6%. Okay? The industry average for computer hardware companies, 38.4. Right off the bat, that lets me know that I should be looking to invest in one of their competitors and not them. If they're at 14% and the average is 38%, meaning there's people well above this. This is the average of the market, of their industry. Average is 38, but they're at 14.6. Lets me know I probably should find another company to invest in. Same with net profit. 17.8 is the industry average. They've been at 6% over the past 5 years on average. So they are trailing behind their competitors. Why would I invest in this company if they can't meet the margin? Now, we're not talking about a startup. We're talking about a company that's been publicly traded for 19 years, since 2007. So this lets me know when it comes to revenues look great, but the margin trends are frightening when compared to the industry. And when you look at them in comparison over time, margins are barely upticking while revenues are going up. That means this company is getting more market share. They're selling more to customers. However, the cost is so high of their newer product mix that it's killing their margins. So let's look at debt to free cash flow. How long can the company pay off its long-term debt with the cash that they're generating from their operations? This is what we're looking at. We want a company to be 3 years or less or 5 years or less, depending on the business. We'll accept that. So as we see, this company has had negative cash flow for various reasons. Reinvestment into the business, stock-based compensation, things like that have killed their cash flow. And so over the past few years, we have 1, 2, 3, 4 over the past 10 years, 4 years of negative cash flow. Okay, so this company is not bringing in cash every year with their operations. They may profit, which means they have a claim to cash, but through their operations, they're not bringing in cash because they have to reinvest or do whatever they have to do with their free cash flow, leaving it negative. So right now in a solid position in 2025, 3.1 years to pay off the cash flow, but then with negative cash flow, that means they're not generating cash to pay off their debt. So if that's the case, if a company is operating and they don't have cash to fund their business because they have negative cash flow, they have more cash going out the door than what's coming in, how are they funding their business? Where's the cash coming from? Let's look at shares outstanding. And this is why their announcement was concerning to a lot of investors. Because if we look here, looking at their share count from 2007, when they were publicly traded, all the way till 2025, you've had what? 1, 2, let's see, 3. Okay, you got a gap here. But outside of that, the share count has gone up practically every year. That means investors have been diluted as far as what they own of this company every year. Same company, more investors. That means I own less of the business. year after year. You're telling me you're going to be $7 billion more of shares are going to be issued, or debt that could turn into shares. And given this company's history of low margins, of not producing consistent cash flow, why would I believe that they're going to be able to pay off those debts if they issue some debt for that $7 billion versus just transferring that to equity? And now I'm even more diluted. Can't trust it. So this is why investors are savvy investors. I would say it's a savvy move, because you think about what their trends are, and if they want to add to this, which they do, that's going to be bad news for you in the future. Let's go to economic value added. This is one of the greater quality metrics that I look at, I believe. I'm looking at what's the return on capital versus the cost of capital. How much does it cost you to have the capital for the business, and how much are you returning on that capital? I like to look at that spread. So at first glance, without knowing much about the industry, we see 17.8 return on capital with a 10.48 cost of capital, averaging over the past 5 years about 7.3%. This company is creating economic value at a rate of 7.3% over the past 5 years. Not bad. However, when you look at the other computer hardware companies, we see a similar picture that we saw when we looked at the revenue and margin trends. 44.7 is the industry average. 9.7 is the weighted average cost of capital. That's the average for the industry. So they're producing 7.3, but their competitors on average 35.05. And some of these aren't direct competitors. Some of these are computer hardware companies, just to give you a picture of what their structure is, or who I'm comparing to. 35%. Again, unless we know there's other businesses in the computer hardware industry that I need to be evaluating as possible investments, because they are pretty much better management teams, better positions, better product mix, whatever it is, they're performing at a much better rate than Supermicro. So that is another sign that this is not the highest quality business to invest in right now. So with that said, let's look at a quick, simple valuation. So a few things I want to point out. So over the next 4 years, they're projected to grow at about 44% per year with the orders that they have, with the booming AI, with the servers that people have ordered from them. 44% per year is what they're projecting. Now, over the past 5 years, they're averaging 49%. So if they keep, pretty much the projection is they can keep up with that trend as far as growth of their business. So we're looking at about 44% growth. For the discount rate, I chose 15%. Yes, their weighted average cost of capital is 10%. But looking at the lack of quality of the business that I've seen, looking at they're going to dilute the business a lot more. The revenues are going to grow, but the margins are very thin compared to their competitors and other people in the computer hardware industry. I'm going to increase that a little bit to 15%. That's my hurdle rate for this investment. Terminal value. How many times free cash flow can I expect this company to sell for 4 years from now? I chose 3. Very, very low. Very low. Probably haven't done it. Typically, if this is what I believe about the business, I won't even value it. I won't waste my time looking at it. However, when you look at the past 19 years, this is the average multiple this company is traded at. Actually at 3. That might sound crazy, but remember when we looked at the chart, we only had a short period of time right here where this company traded at somewhat of a high valuation. Other than that, it's been pretty flat. So when you think about that picture, then maybe 3 times free cash flow doesn't seem so crazy. Over the past 19 years, this is their average that they've been trading at. So I'm going to not be over optimistic, and I'm going to assume that this company will be trading at the average multiple in 4 years from now, as it has been in the past 19 years. With that said, share price at 30.4. My guesstimate about this business, I think the intrinsic value is somewhere around $21.54. My little range, 19 to 24, is what I say the range is. And somewhere within that range is the fair value of this price. So with that said, this stock is not, relatively $8.92 is a lot of money. However, given that we're only looking at $30, that is a significant 29% downside. But for those that have a different story about this business, you might see it as fair value. I respect that. It's not a big difference here. However, given the factors that I explained, that this is not the most quality business, management doesn't have the best integrity. They were delisted before. They've been threatened to be delisted again. So that could raise some questions about some of their accounting. Some research firms have issued some reports about some discrepancies in their reports, in their accounting reports as well. So you can research that to get a better idea of what I'm talking about when it comes to the management's integrity. But again, can't expect a high valuation in the future, even with this growth, because they've had this growth in the past, and this company is still trading not very high. I think the PE right now is about 16. That's their earnings. That's not really their cash flow. I like to look at cash flow. Cash flow, the multiple is much lower than that. So this is my analysis. Let me know, again, if you have a positive story about this business and you think that as they fulfill these orders, their financials are going to look a lot different in the future, adjust your evaluation to your expectations. But this is where I'm landing at, 2154 for this business. And again, there's a lot more businesses out there that are quality businesses that are leading their industry as far as when it comes to quality and adding value to the entity and to the shareholder. So that's my estimate about this business. Let me know what you think in the comments. See you in the next video.